Right now, most people watching this crash are looking at the wrong thing. They're staring at the headline numbers, oil prices, red portfolios, gas station receipts, and they're reacting to what they see instead of understanding what it means. In the last video, we broke down why this sell-off is being widely misread. Today, we go one level deeper. Today, we talk about what institutional money is actually doing, not what it's saying on television, not the carefully managed PR version of events, but what it's doing with real capital in real portfolios right now, in late March of 2026. There is a private research document circulating right now among the most powerful asset managers on the planet. Not among everyday investors, not among people watching YouTube, among clients who pay Bank of America $50,000 a year just for access to what the bank's top analysts actually believe, as opposed to what those same analysts say when a camera is pointed at them. I have seen that document, and what it lays out about the next 30 to 60 days of American economic life is something every serious investor needs to understand. Because the difference between the people who will look back on March 2026 as the greatest wealth-building moment of their lifetime, and the people who will look back on it as the crisis they sat through and missed, that difference isn't intelligence, it isn't connections, it isn't a Bloomberg terminal. It's whether you understand right now the mechanism that turns geopolitical catastrophe into financial opportunity. That's what we're going to build together today. Let me give you the context first, because the numbers matter. It is Tuesday, March 31st, 2026. 5 weeks and 2 days since Operation Epic Fury launched on February 28th, the night American and Israeli aircraft struck Iranian military installations. Iran responded by doing the single thing the global economy feared most: seizing control of the Strait of Hormuz, the narrow waterway through which roughly 20% of the world's traded oil passes every single day. Brent crude is trading this morning near $113 per barrel, up from around $73 just 6 weeks ago. That is a 55% surge in a single month, confirmed as the largest monthly gain for Brent crude in the history of the contract, which dates back to 1988. The previous record was a 46% gain in September of 1990 during the first Gulf War. We just shattered it. WTI, the American benchmark, is hovering near $112 per barrel. Gold, which opened the year near $5,500 an ounce at its January all-time high, is now trading around $4,530, down nearly 19% from that peak. Silver has fallen even harder. The S&P 500 has dropped approximately 7.5% from its January high. The University of Michigan's Consumer Sentiment Index has collapsed to 57.3, one of its weakest readings in years, putting current American consumer confidence in the bottom first percentile of the survey's entire recorded history. Year-ahead inflation expectations have jumped to 3.8%, the biggest single-month increase since last April. Gas prices in California are brushing $9 a gallon. This is what I'm calling the everything crash. And I want to be precise about that phrase, because it's not just a dramatic label. The everything crash is the simultaneous breakdown of every traditional safe haven that investors have historically retreated to when the world falls apart. Stocks are falling, gold is falling, consumer confidence is in free fall, and the people managing the majority of money in the world are currently doing one of two things: panicking and selling, or freezing in place and doing absolutely nothing. Both of those responses, I'm going to argue to you today with evidence, will look catastrophically wrong 6 months from now. The investors who will be right are the ones who understand not just what is happening, but what always comes next. And what always comes next in every major oil shock of the last 50 years is a policy panic followed by a violent, fast, large repricing upward of the most beaten down assets. Always, without exception. So let's start there, with the mechanism that Bank of America has specifically identified in its private note. Because once you see it, the investment opportunity that exists right now in late March 2026 stops looking complicated and starts looking almost obvious. Here's the thing that should not be happening right now, according to conventional economic logic. Bond yields are falling, even as oil sits above $113 a barrel. Read that again. Yields are declining while oil is at a 4-year high. That is not what the textbook inflation-fighting framework that has governed monetary policy since 2021 says should happen. When oil spikes 55% in a month and inflation expectations jump to 3.8%, yields should be rising, the Fed should be hawkish, and rate-sensitive assets should be under pressure. And for a brief window after the war started, that's exactly what happened. Then something shifted. The bond market, the largest and most analytically sophisticated market in the world, populated not by retail traders, but by the most rigorous institutions in global finance, began sending a different message. It began arguing that oil above $100 is not primarily an inflation problem. It is primarily a recession problem. Bank of America's private research calculated this inflection with notable precision. In the $80 to $100 range, the bank concluded inflation risks dominate and a hawkish Fed makes sense. But above $100, the math changes. Oil at these levels is so economically destructive, hammering consumer spending, corporate margins, airline profitability, manufacturing costs, and discretionary income, that the recession risk it creates begins to eclipse the inflation risk. And when recession risk dominates, the Federal Reserve doesn't raise rates. It cuts them, or it finds a way to ease monetary conditions through the back door, through bond purchases, through quantitative easing, rebranded under a more politically acceptable name, through the quiet financial engineering that central banks have deployed in every crisis since 2008. That pivot, from inflation fighting to recession fighting, is what Bank of America's note calls the policy panic. And it's coming. The only open questions are the trigger and the timing. Goldman Sachs has flagged that another 5 to 7% downside remains possible if the strait stays closed. Morgan Stanley's Michael Wilson has pointed out that technical indicators, including the RSI, are flashing oversold signals not seen since 2022, suggesting the correction may be entering its final stages. Both of those things can be true at once. There can be more downside, and the correction can be near its end. What matters is not picking the exact bottom. What matters is knowing which assets move fastest and most violently when the policy panic arrives, and being in position before that move happens. Here's the brutal truth about crisis investing that institutional money discusses in private and almost never says in public. The confirmation of a recovery always arrives after the move, not before it. By the time you see the headline declaring the market has turned, the investors who positioned correctly are already up 25%. If you've watched this far, you're the kind of person who wants to understand markets at the level hedge funds understand them, not at the level cable television explains them. Stick with me, because what comes next is the specific sector-by-sector playbook that institutional money is using to position for the policy panic, plus the 3 rules I've extracted from watching 4 decades of these crises play out. Let me tell you precisely what Bank of America is telling its wealthiest clients to buy. But first, a distinction I consider the single most important analytical framework for navigating any crisis: the difference between assets that are structurally impaired by the oil shock and assets that are only temporarily repriced by the shock's effect on sentiment. That sounds academic. It isn't. It's the difference between buying something that will recover and buying something that deserves to be lower permanently. Structurally impaired right now, airlines. They face direct, immediate, largely unhedgeable fuel cost increases that are crushing their margins this quarter, not in some hypothetical future. Buying airlines here means buying into a business whose core cost structure has been radically disrupted, with limited ability to pass those costs to consumers in a recessionary environment. also structurally impaired, unprofitable growth companies that depend simultaneously on cheap capital and strong consumer spending, and any business with meaningful exposure to Middle Eastern supply chains or distribution routes requiring Hormuz transit. These are not temporary repricing situations. These businesses are genuinely worth less at $113 oil than they were at $73 oil. Now here's where it gets interesting. The temporarily repriced assets, the ones that have been marked down by sentiment, not by actual fundamental damage. These are the opportunities Bank of America's research is flagging. The first category is energy infrastructure, not the oil producers themselves. Those have already spiked dramatically since February 28th and represent a crowded trade where most retail investors are arriving after institutional money has already collected its gains. The real opportunity is in the pipelines, the storage terminals, the LNG regasification facilities, the companies that move hydrocarbons rather than produce them. Think Kinder Morgan, Williams Companies, the midstream MLP ETF space. These businesses run on a toll model. They collect a fee on every barrel and every BTU that flows through their systems, regardless of whether Brent is at 80 or 113. They benefit from elevated oil prices without bearing the commodity price risk that makes pure producers a volatile bet at these levels. And they benefit from something even more durable, the permanent restructuring of global energy supply routes that the Hormuz disruption is forcing on the world. Every country that just watched 20% of global oil supply disappear through a single choke point is now spending money on redundant infrastructure. That spending will continue for years after the strait reopens. The second category is defense and aerospace. But let me make a critical point here, because the casual financial media treatment of defense stocks tends to reduce them to a simple conflict trade. Buy when they're shooting, sell when there isn't. That's not how institutional money thinks about defense in 2026. Morgan Stanley has argued explicitly that increased exposure to defense, aerospace, security, and industrial resilience themes is justified on the basis of government spending patterns that will run for multiple years after the immediate military operations conclude. Consider this. After September 11, 2001, defense stocks outperformed the S&P 500 by 47% over the subsequent 5 years. Not because the wars in Afghanistan and Iraq lasted 5 years. Because the structural reallocation of government spending that followed those attacks persisted long after the immediate military crisis had passed. The ITA Aerospace and Defense ETF provides broad sector exposure without the company-specific risk of a single contractor losing a major bid or facing a reputational crisis. The third category is the counterintuitive one, and I want to spend real time on it, because it's the category most retail investors will find psychologically difficult to act on, which is precisely why it's the most powerful opportunity available right now. Consumer discretionary, restaurants, retail, travel, luxury goods. These stocks are trading at valuations not seen since the depths of the global financial crisis and the worst of COVID. More than half the stocks in the S&P Consumer Discretionary Index are sitting at least 20% below their prior year highs. The historical data on what follows this level of valuation depression relative to the broader market is remarkable. In 23 of the previous 28 instances when consumer discretionary reached this level of relative pessimism, the sector produced an average of 14% outperformance over the following 12 months. That's an 82% historical hit rate. Think about what that actually means. The moment that feels, to the investor sitting inside it, like the absolute worst possible time to be buying restaurant stocks or retail chains. That feeling, that visceral sense that now is the most dangerous moment to step in, is precisely the sentiment signal that has historically preceded recoveries, not continued declines. Consumer discretionary is being priced as though the American consumer is permanently broken. They're temporarily shocked by a war that's pushed California gas toward $9, that's collapsed confidence to the bottom percentile of its entire historical range. When this shock recedes, through diplomatic resolution, military success, the simple passage of time, or some combination of all three, the consumer will come back. And the stocks that reflected maximum pessimism about that consumer will move sharply. The fourth category is software and consumer finance. Software is being treated in this sell-off as though the AI revolution was canceled by the Hormuz closure. It wasn't. The $300 billion in data center investment that Microsoft, Amazon, Google, and Meta have committed to over the next 3 years doesn't evaporate because Brent crude is at $113. That investment continues. The AI capital expenditure cycle is driven by competitive dynamics among the largest technology companies on Earth. Software companies serving the AI build-out are being sold alongside everything else in a panic liquidation that doesn't bother distinguishing between businesses that are actually impaired by the oil shock and businesses that are simply being marked down because the VIX is elevated and institutional portfolios are deleveraging indiscriminately. Consumer finance benefits structurally when rates eventually fall, and the bond market, as we covered earlier, has already begun pricing that fall. Let me add gold here, because its current price deserves a careful explanation rather than a dismissive headline. Gold entered 2026 at an all-time high near $5,589 an ounce in January. It's now trading near $4,530, down roughly 19% from that peak. The easy interpretation is that gold has failed as a safe haven. The accurate interpretation is more complex and, frankly, more interesting. Gold hasn't fallen because its structural case has deteriorated. The long-duration argument for gold, the 40-year global debt supercycle, the $39 trillion American national debt, the mathematical unsustainability of current interest rate levels, none of that has changed because of the Iran war. What has changed is that margin calls, forced institutional liquidation, and algorithmic selling into falling yields have created temporary selling pressure that is entirely disconnected from gold's fundamental value argument. The investors who understand this distinction and who can hold through the volatility are looking at gold near $4,530 and seeing an asset that was $5,500 6 weeks ago, whose fundamental case is arguably stronger today than it was then. Now let me give you the 3 rules I've observed across 4 decades of watching crisis investments unfold, not as abstract principles, as specific actionable guidance for the moment that exists right now. Rule 1. Don't buy what has already spiked. This sounds obvious when you say it plainly. It's almost never followed in practice. Oil companies spiked hard in the days immediately after February 28th. The investors who bought Exxon that night or Lockheed Martin the morning of March 1st made significant returns. The investors buying those names today, on March 31st, are arriving at the party after institutional money has already collected its gains and repositioned. This isn't a judgment on the long-term fundamentals of energy producers or defense contractors. It's a statement about the mechanics of how gains are distributed in crisis periods. The first move belongs to whoever was positioned before the crisis hit. The second and third moves, the policy panic move, the recession pricing pivot move, belong to whoever understands the sequence, not just the headline. Rule 2. Follow the money, not the headlines. The headline of this moment is oil at $113. It's dramatic, it's real, and cable television will discuss it endlessly. The actual signal, the thing that tells you where the next money flows, is bond yields falling despite oil sitting above $100. Those 2 facts together constitute the bond market's verdict on what the next chapter of this crisis looks like. The bond market is saying recession risk has overtaken inflation risk. And when recession risk dominates the analytical framework, a specific set of assets experiences the fastest and largest recovery. Rate-sensitive stocks, beaten down consumer businesses, technology companies whose revenues aren't impaired by oil prices, and gold once the forced liquidation wave passes. These aren't guesses. These are the assets the bond market's current behavior implies will benefit when the policy panic arrives. Rule 3 is the least exciting but the most essential. Remove leverage before you do anything else. Before any opportunity discussed in this video can benefit you, you need to be in a position to hold through continued volatility. Goldman Sachs has explicitly flagged that another 5 to 7% downside is possible if the Strait of Hormuz remains closed through April. If you're leveraged and the S&P falls another 6%, that leverage will force you out of your positions at precisely the worst possible moment, the moment of maximum pessimism that historically and immediately precedes the recovery. The investors who built generational wealth in 2009, in 2020, and in every other major crisis of the past 30 years weren't the smartest people in the room. They were the ones who could hold. The investors who lost money in those same crises weren't stupid. They were leveraged. Remove leverage first. Position in the beaten-down assets with intact structural cases second. Wait for the policy panic third. Those 3 steps, in that order, are the institutional playbook. Let me close with the historical context that I believe is necessary to understand the magnitude of this moment. The International Energy Agency has characterized the current Hormuz disruption as the largest supply disruption in the recorded history of the global oil market. Every previous oil shock of comparable scale created extraordinary investment opportunities for the investors who understood the mechanism rather than just the headline. In 1973, the Yom Kippur War oil embargo preceded a 2,300% gain in gold over the subsequent decade. In 1979, the Iranian Revolution and the resulting oil shock preceded years of outperformance in defense and energy infrastructure. In 1991, the Gulf War shock resolved into a broad market recovery that rewarded the investors who held through the panic. In 2001, the trauma of September 11th preceded a decade-long gold bull market that began around $250 per ounce. In 2008, the investors who bought quality assets at the bottom of the financial crisis made 300 to 500% over the following decade. Experts are characterizing the Iran war of 2026 as the most structurally significant energy shock since 1973. And like every previous crisis of comparable magnitude, it will end. The Strait of Hormuz will reopen through military success, through diplomacy, through the economics of Iranian fiscal pressure, eventually making the closure untenable, through some combination of all 3. Trump has publicly stated he's willing to consider ending operations even if the strait remains partially restricted, a signal the market is watching with intense attention. Oil at $113 will not persist at these levels indefinitely. The demand destruction it creates, already visible in consumer sentiment collapsing to 53.3, in the cratering of discretionary spending expectations, in the recession shadow that the bond market is already pricing, eventually overwhelms the supply shock. Oil comes down, the Fed pivots, the policy panic arrives, and then investors positioned correctly before it happens collect returns that would take years to achieve under normal market conditions. The S&P 500 sits roughly 7.5% below its January all-time high. Gold sits 19% below its January peak. More than half of consumer discretionary stocks are down more than 20% from their prior year highs. These are not the readings of a market that has accepted its fate and moved on. These are the readings of a market in the acute phase of shock, the phase that in every historical analog has preceded recovery, not further deterioration. The confirmation will come, the rally will come, the policy panic will arrive, and it will reward the investors who were early. The investors who waited for certainty, who waited for the headline saying the war is over, the strait is open, the Fed has cut. Those investors will be reading about the returns that were available in late March 2026, long after the window to capture them has closed. If they keep falling while oil stays elevated, the market is confirming the recession-dominant framework, and the policy panic is approaching. Watch for any credible diplomatic signal, any sign of back-channel communication between Washington and Tehran leaking into the reporting. Watch for Federal Reserve language that begins shifting from inflation caution to recession caution. Those signals, when they arrive, are the trigger. But the position needs to be established before the trigger, not after it. The trigger produces the move. The move rewards the position. The position has to already exist. Drop a comment below right now. Are you positioned for the policy panic? Or are you sitting on the sidelines, waiting for certainty that will always arrive after the move, never before it? That conversation between the people who watch Finance Zone USA and actually think at this level of depth about what markets are doing and why is one of the most valuable things that happens on this channel. If this video gave you a framework rather than just a headline, hit subscribe and turn on notifications. We cover this stuff every week, and you don't want to be the person who found this channel after the opportunity already closed. The question of what comes next, after 5 weeks of war, after oil at $113, after gold down 19%, and consumer confidence in the bottom percentile of its entire history, doesn't have a single clean answer. It has a framework, and the investors who hold that framework are the ones who will look back on this moment not as the crisis they survived, but as the opportunity they seized.